The number of exchange-traded funds available for you to buy is absolutely bananas. As of 2020, there were over 7,600 different ETFs out there to be traded on the stock market. And every year, more and more new ETFs get launched while others get closed and liquidated. Yes, you heard me right, ETFs can be shut down because they're poor performers. It's a dirty little secret of the ETF industry that we'll cover later in this video. Since there's over 7,600 of these things, how are you supposed to know which one is right for you? My vote would be to just throw darts at a dartboard to decide, but if we did that, then we'd probably be putting all of our money into things like GameStop, AMC, Dogcoin, and Miley Cyrus NFTs. Not your worst idea, but definitely not your best. So in this video, I'm going to go through my preferred process of how to evaluate and pick an ETF that works best for you. Think of this like a little checklist for you to go through when evaluating and analyzing one ETF among the thousands that are out there, so that you're not just closing your eyes and playing, I don't know, pin the tail on the donkey. Now keep in mind that there's different investing strategies where you invest in individual stocks as well as ETFs, which is perfectly fine. I'm personally not someone who prefers to put my money into single stocks, so I'm not your guy for that type of thing. But I can help you with the ETF portion of your portfolio. Hey, I'm Jarrad with 2 A's and 2 R's. Over here, we like to talk about investing and financial independence. If you get some value from this video, then help support my dog Molly by Hulk smashing that thumbs up button. Not all ETFs are created equally. Now, you'll generally hear advice to invest in ETFs as opposed to stocks, but that advice, while good, isn't specific enough. There's a lot of trash ETFs out there, so I'm going to help you distinguish between the good, the bad, the ones that fit your style, and the ones that don't. All an exchange-traded fund is a type of investment fund that holds a basket of stocks. There is no set minimum or maximum amount of stocks that will be held within a specific ETF. It's going to vary from ETF to ETF. ETFs are kind of like mutual funds in the fact that it holds a group of stocks within it, but unlike mutual funds, ETFs can be traded throughout the day when the stock market is open, just like individual stocks can be. For example, Vanguard offers the Vanguard Total Stock Market Index Fund Admiral Shares, which is a mutual fund that goes by the ticker symbol VTSAX, but they also offer the Vanguard Total Stock Market ETF, VTI, which is the ETF version of VTSAX. VTI, the ETF, holds the same exact basket of stocks, except VTSAX has a little bit higher expense ratio. There's a minimum of $3,000 to invest. It's only traded at the end of the day after the stock market closes, and you can only purchase it through the Vanguard investing platform. A good way to start this whole process is by using an ETF screener website like ETF.com or ETFDB.com. Either one will work for you. The first thing you want to figure out is the type of asset class that's held within that ETF. Some ETFs are made up of stocks, or sometimes referred to as equities. Some are bonds, and then we also have commodities like a gold or silver ETF. If you're young and looking to maximize your growth, you might not want to do anything with the bonds or gold, so you can ignore those types of ETFs right off the rip. At this point, I would decide if I'm looking for an ETF where most of its holdings are in a particular country. For me, I prefer the United States for most of my ETFs, but sometimes it's good to have a little bit of exposure to those international investments as well. Next, you'll need to pick a sector so that you can drill down a little bit more into what exactly you're looking for. Now, there's about 11 different sectors to choose from. These are things like energy, consumer staples, information technology, financials, and a few more. You can also choose ETFs that are specifically large, mid, small, micro, cap specific, or even total stock market, where you can own a little bit of everything. The reason that you might want to pick a specific ETF sector is to gain a little bit more exposure in an area that you might be a little underweight in within your overall investment portfolio, or as a way to kind of take advantage of a growing sector you might see a bright future for, like the work from home stocks. For example, if your portfolio was broken up into large cap IT and consumer staple ETFs, you might be thinking to yourself that you want some more money invested into financials and healthcare as well. In that case, you'd go find these two types of ETFs and add those ETFs to your portfolio. ETFs are a great way to fill some gaps within your overall pie, so that all of your money isn't concentrated into only a few different areas. On top of that, by picking an ETF, it's saving yourself time from having to go through and evaluate potentially hundreds of individual stocks within that financial and healthcare sector to decide which ones you feel confident buying. To be honest with you, there's an ETF for just about everything that you're looking for. Back to my recent example, there is a work from home ETF, which adds a bunch of stocks that will most likely benefit from the work from home movement that we've been seeing recently. If you're not sure where one might fall within these sectors, then just do a quick Google search for that sector and the letters ETF right after. So if I want to find video gaming, gambling, or even SPAC specific ETFs, then I'd search for that and start diving into each one that pops up, which I'll show you how to do in just a second. Now that you've picked out the specific sector of ETF you're looking for, it's time to start looking through them individually. This might seem like a daunting task, but I promise you it's a lot easier than trying to sift through the financials of individual stocks. That's because every ETF has a specific goal or objective that makes it unique from the rest, which means that they've already done all of the work picking the individual stocks that fall within those guidelines. By understanding the goal of an ETF, it's going to help you narrow down the search based on what exactly you're looking for. If you were looking for a United States IT specific ETF, then we could start out on ETF.com to find a list or search for it in the investing platform that you plan on using to make sure that it's available there. In this case, you'll go to ETF.com and drill down to the IT specific options. Here's a list that they've sorted from highest to lowest assets under management. Now, since those top two are the biggest by a long shot, we'll start the process by evaluating both of them. One quick step that I'd like to add in right here is to check to make sure that these ETFs are offered on the investing platform that I would plan on using or you would plan on using. You want to check that out, because if they're not, then there's no reason for you or me to continue with this search. In this case, M1 Finance is my platform of choice, so I'll do a quick search right there. And as you can see, both of these ETFs are offered through M1 Finance. If you want to check them out as well, then use my link down in the description of this video to open up an account. If you use that link, you'll receive a free $30 when you deposit at least $100 into a taxable investment account or $500 into an IRA. Now that we have that done, let's check out the description. It looks like VGT tracks a market cap weighted index of IT companies, and XLK tracks an index of S&P 500 tech stocks. Reading a little bit more about the analytics insight for each one gives us a better understanding of what the deal is with each of them. The next thing that's extremely important to understand is the expense ratio for an ETF that you're looking at. This is of course going to be the fee that you pay for owning that specific ETF. One thing to always know is there is no free lunches in the ETF game, which is perfectly fine. There's no issue with that, but we want to try to avoid getting all of our lunch money essentially taken from us. The higher fees are usually associated with actively managed ETFs. The passively managed ETFs are about as dirt cheap as it gets. An ETF like VOO is a passive ETF because it tracks the exact same holdings that are a part of the S&P 500. The fund manager isn't trying to actively pick which stocks to hold within that ETF because the S&P 500 is already determining that for them automatically. It's a lot less work, which is going to make it a lot cheaper to own. On the other hand, an ARK ETF like ARKK is an actively managed ETF because they're actively buying and selling their holdings on a regular basis. The actively managed funds usually cost more than passive because there's a lot more work going on behind the scenes to pick those individual stocks. Kathy Wood from ARK has employees who are out there doing research on different companies, different sectors, and trying to gather as much intelligence as possible so that they can predict where they should be investing money for that specific fund so that they can hopefully beat a passive index like VOO. This is why the expense ratio for an ARK ETF is 0.75% versus the 0.03% that's charged for VOO. I know that 0.75% doesn't sound like a lot on the surface, but an ARK ETF is basically 25 times more expensive than a passive ETF like VOO. There's nothing wrong with this if you're looking for an ETF that invests like ARK does, but you better hope that their returns beat a VOO ETF over a long period of time. To give you some context on how much these fees actually cost you, NerdWallet ran a scenario a couple years ago on how much a 1% fee would cost someone over a 40-year time period. They found that paying a 1% fee would cost about $590,000 in sacrificed returns. Now, I didn't do this specific math, but at a 0.75% expense ratio, that would be around around $300,000 to $400,000 lost in returns. I don't know about where you're from, but here in the Midwest, that's equal to about 4 or 5 cash flowing rental properties. Expense ratios matter in the long term, even if they look really small on the surface. Now, I personally try to stay under 0.20% if at all possible, but as with everything, there's usually exceptions to the rule. The next thing you'll want to take a look at is the overall number of holdings and how much of those overall holdings is concentrated within the top 10. Sticking with the 2 IT ETFs that we've been talking about, VGT holds about 359 stocks and XLK holds 76. Right there, that tells us that VGT is a little bit more diversified than XLK. We can dig a little bit deeper to understand how each of those holdings are broken down from a large, mid, and small cap perspective. In the case of VGT, we can see that the majority of it is in large cap companies, which are a bit more stable, but it also has some exposure to mid and small cap companies as well. With XLK, 99% of it is large cap, so basically the whole thing. Generally speaking, a good rule of thumb is that large cap stocks come with lower risk and potentially lower returns. Mid-cap stocks come with high risk, high reward. Small cap come with higher risk, higher reward. And micro caps are the highest risk with the highest reward. When we look at the top 10 breakdown of sectors, we can see that the majority of the 100% pie for both ETFs is going into software and IT, computers, phones, and semiconductors. Since these are both technology ETFs, this makes complete sense and doesn't really throw up any red flags for us. Now, if we saw either of them allocating a percentage to the financials or consumer staples sector, then we might want to question why, because those don't directly have much to do with the technology space. Looking at how much of the portfolio is concentrated into the top 10 will give you a good idea of what's going to be making this ETF move in either direction. In the case of these 2 examples, we're looking at the top 10 accounting for about 57% and 66%, which is quite a bit. To give you an idea of how I personally gauge this, I'd say that if the top 10 makes up 30% or less of the whole overall holdings, then that's a pretty conservative amount. Of course, beyond that, you have to look at how that percentage is broken down among each of the top 10 companies. If it was spread evenly among all of them, then that's even more conservative. If you look at VGT and XLK, more than half of the money that's allocated to the top 10 is going into Apple and Microsoft. With that much of the overall pie going towards these companies, they're going to play a big part in the price going up and down. So essentially, for every $100 that you invest into VGT, $20 of it is going to go into Apple and $16 of it is going to go into Microsoft. Now, there's nothing wrong with that. I'm not saying that it's a good or bad thing. It's just something to be aware of when investing in this ETF or any other ETF. It's good to pay attention to this sort of thing. If you were someone who didn't see a bright future for Apple or Microsoft, then you might want to think twice before picking up one of these ETFs, because the majority of your money is going to be put into both of those companies. As you look at more and more ETFs, you might start to notice that most of the ones that have been around for long enough have all performed fairly well. There's a reason for this. If an ETF isn't performing well for long enough, then the company managing that investment or that ETF is able to completely shut it down altogether. If this happens to one that you own, then there's really nothing to worry about, because they won't go running off with your money. You'll still own those specific shares until the fund closes on the date that they announce to you. You'll probably be down some money, but it's not just going to disappear one day. This isn't super common with some of the larger ETFs, but some of the smaller and sector-specific ones, you got to be careful, because they are a little bit more risky. If they're not performing very well, that managing company could decide to just cut it off one day and shut it down. After they announce a closure, you'll usually have between 30 to 60 days to liquidate your holdings. Now, if you don't do it by that point, then they'll usually do it for you automatically, and the cash will show up in your brokerage account. To be honest, we could go deeper with our analysis when picking an ETF that's right for you, but what we've touched on in this video is a really good place to start with the whole process. If you want me to make a deeper dive video, then let me know in the comments down below. Now that we've covered the things you need to think about in detail when picking an ETF, let's just do a quick recap so that you can create a little checklist for yourself. Number 1, choose an asset class. Number 2, choose a location. Number 3, choose a sector. Number 4, pick 1 or 2 ETFs to look at and compare. Now make sure to double check to make sure that it's offered through your investing platform of choice. Like I said, I'll have a link in the description to get a free $30 from M1 Finance if you're interested. Number 5, review the objective of that ETF. Number 6, understand the expense ratio. Is it an active or passively managed ETF? Number 7, look at the number of holdings. How does it break down at a large, mid, small, and micro cap level? What's the percentage breakdown of the top 10 sectors, the top 10 holdings? If you have any ETFs that you want me to look at, break down, and give you my thoughts on, then leave those down in the comments below and I'll do my best to get to them. Don't forget to smash that thumbs up button before you go. It really helps me out and I really appreciate it. Check out the description to get some free stocks as well as more resources and playlists on investing and financial independence. I'll see you in the next one, friends. Done.